Well, it's good to be here. I want to thank Jana as well. She does an amazing job in keeping the room full. Asking a CPA to not share numbers is pretty difficult. So I was twitching yesterday trying to figure out how to present information. So there will be some, full disclaimer, some statistics, but I'll try to brush through them quickly and get to the story. Just in general, you can see that slide shows transaction volume throughout the United States year over year. The big saddle is the recession. 2015 hit a really high peak, and then we saw just a little tapering, but very healthy transaction volume. 2018, we saw a climb. So just briefly showing that we're in a healthy and stable market. We have great debt, tax reform, which has really helped, and then opportunity zone funds, other things that are exciting for commercial real estate investors to take advantage of. Cap rates, you can see just in general strokes there, maintaining their place. Retail slightly uptick in cap rate, and industrial slightly downtick. Office and apartments have held ground. So we're in a really healthy market so far, and expect it to continue. Who knows how long, but it's been good so far, and the debt markets have held, kind of lived with that little bump and then come back down, and it's, I think, emboldened a lot of people in their strategies going forward. The majority of the time I want to spend is on the Boise housing market, trends that we're seeing. A lot of questions come up. How are we dealing with continually rising construction costs? Are there too many apartments being built? How are we absorbing all these apartments? It seems like on every corner something's going up. So I want to put some context to those questions. First, just if we see where we've been in the last 8 years, obviously part of this dramatic jump in pricing in Boise is related to our downward slide, but from 2010 to 2018, home prices rose 83% in Boise. A huge and kind of surprising number, but in context of other cities nearby, our price per foot is still significantly lower. So Idaho still provides for others looking at a state to live in affordability and a great quality of life. What does life look like from the standpoint of a renter? This is a more dramatic example, but Reflections is an apartment complex. In 2010, you could have rented a one-bedroom unit for $700 a month. Today, over $1,200. This is due to rising rents in addition to improved amenities and an improved space at that project. Looking at the construction pipeline in Boise, the yellow kind of mark shows just the added units each year. Overall, over the last 4 years, we've added about 6% per year. Some years it's come in more dramatic fashions. 2016, we added right around 11% inventory to the supply of apartments in Ada County. So if you look at that, you say, well, that could lead to drop in occupancy, increased vacancy, lowering of the rates. How that plays out, not quite. You can see the slide that shows the number of units as they've increased year over year. We've maintained occupancy from 2011 to 2018 of between 95 and 98%. So the market's just completely absorbed any supply that we were able to deliver so far. How does that affect rates? Similar story on rent growth. Again, we've maintained solid occupancy in the face of heavy rent growth. Over that 8-year period, rents have increased over 50% through that time. So the real question becomes, with rising rents and demand there, construction costs have outstripped the rental rate increase. What we're seeing now is a lot of out-of-state developers that love Boise. They want to be here either from just a purchasing standpoint or a development standpoint. They can't get the scale they want from an existing product standpoint, so then they want to build and develop. The challenge is the construction costs are too high relative to suburban market rents. So there's a continual pressure for developers to look at the downtown core. We've also seen recently, you can see that last 2018 bump in rents, and there's been a couple articles in the paper about how much rent growth we've had. It's a little bit skewed because we've added downtown housing, which typically is over 50% higher than the submarkets. And so it's affected when you just take an average rate, you add those downtown units at over $2 a foot, it's caused the average to go up more than maybe it really has. So we look to other markets and say, well, what are other markets doing? How are they addressing the issue of rising construction costs and delivering a product that people want? Part of it is one concept is co-living, similar to what Al shared about office. There's the old co-living concept was not that fun because of the shared bathroom. All it took was one bad roommate, and it ruined the fantasy of having a nice roommates. But now you have bedrooms with kitchenettes and private bathrooms, and then shared kitchen spaces, shared media spaces, entertaining spaces, laundry, and game rooms. And so that's an amenity that's driving into projects to allow tenants to afford the things they wouldn't be able to afford in their own unit, shrinking their actual livable space. The other is similar to office again, is the amenities where we're seeing continually landlords figuring out how to justify the rent and drive the value there for the tenants. As a nation, we spend more on pets than we do on children between the ages of 0 and 15. Landlords react to that. They say, hey, we need a dog park, we need a dog grooming station. And so you see amenities continually rising in these projects to justify their rents. The other thing that happens as developers look at product and what they're delivering to the market is how to change the construction type. So even locally, you see on the modular apartment side, the Pacific Company's building a 400,000 square foot plant in Nampa to build modular units for developers. Also, the concept of cross-laminated timber, or CLT. There's a company called Katerra, which is in pre-IPO phase. Their market value today is about $3 billion, and they are working towards a prefab CLT product that can deliver a more efficient and less costly apartment project. In fact, they are involved in one in Meridian right now on Overland and Linder, a 386-unit project. The third is single-family rentals. This is a segment of the market that really took off from the recession. Blackstone developed, they really pushed the scale of this product and went public with a fund called Invitation Homes. Invitation Homes owns over 80,000 homes throughout the United States that they use as single-family rentals. We're also seeing new REITs coming into markets and even into Idaho, looking at buying complete subdivisions or developing complete subdivisions as single-family rental product only for rent. So those are some trends that are occurring. This slide's hard to tell, but it's the percentage increase in apartments is the smaller line. The much larger line is the percentage increase in single-family rentals. So that's a big segment of the market that's becoming more institutional in lending as well. So in conclusion, beyond the boom, I tried to stay away from numbers, but I couldn't. Rising construction costs will lead to innovation in how we build. Rising rents and costs will lead, rising costs will lead to increased rents. And then rising rents lead to an amenity war, co-living, and then increased demand for single-family rentals. Thank you.